performances up to the end of January and news all the way up to date. Before I get started, just as usual, this video is for clients of McGregor Wealth Management, in particular those that use the CARE investment process. For everyone else, you're free to welcome, but please don't act on anything contained in here without seeking your own advice. So we're going to cover all the usual economic news. We're going to have a look at what's happening in the markets. As always, there's plenty happening. And we're going to put into perspective in line with our CARE philosophy, exciting life and book. So let's have a look at the news. The big news in Australia, it's a little bit old now, but just after I recorded last month, the RBA dropped the cash rate. Sorry, raised the cash rate. I'm so used to saying drop the cash rate, but they raised the cash rate to 3.85. It's the shortest time rates have been down in the history of the RBA. So they just finished decreasing, and then a quick increase. And it's because inflation remains stubbornly above the 2.5 to 3%. Now, it's not way above. It's about 3.5 or 3.6, depending on which measure you use. But it's enough for them to be concerned that if they don't do anything, it might start to drift up. And as we've talked about many times, the RBA does not like inflation to get well out of that range. It can feed into wage cycles and price cycles, and everyone's petrified of a return of inflation of the 70s and 80s. Now, they noted in their releases that we've got higher growth and continued low employment. So in other words, conditions are good. Economy is growing at slightly above its expectations, and employment is low. That means everyone that wants to have a job has pretty much got a job. And they also noted that the government spending is not helping. There's been a lot of news about this, a lot of debate about this, and all the actions by the federal government and state governments to spend to pump up the thing, but also to pay people back for energy increase, etc., are actually contributing to inflation. So it's going to be interesting to watch how that comes. Of course, I haven't got it in, but the change in opposition leader, and hopefully it leads to some good debates. The ASX 200 keeps hitting record highs. BHP had a really strong reporting season. Banks bounced back. Those two things are enough to push the index higher, although that wasn't uniform, and that can change pretty quickly at the moment. A couple of days ago, last week, the Trump tariffs were found unlawful by the US Supreme Court. It's always crazy watching American politics, and particularly the Trump era. But Trump just quickly announced universal tariffs at 15%, and he's able to do that. I'm not going to dive into the court interpretation of what's legal and what's different this time, but there was a flutter in the markets. But as the quick response came out, the market kind of went, yep, that's okay. And it's kind of odd because you would expect the markets to have a big reaction. But what they're saying is they've now baked in these tariffs into the US broader market / economy. They've raised a lot of money, the tariffs, and I know that's important to slow down the rise of the US deficit. So, the markets go, yep, bit of a worry, but then we're okay. So that's disappeared very quickly. Now we've got this disparity. While we're increasing rates, the Fed is increasingly looking like dropping rates. So, the Fed, and I've added the US cash rate in, and the US cash rate dropped a while back. It's at 3.75 at the moment. So it's under the Aussie rate, and it's looking like dropping. This is based on market forecast to about 3.25% by September. So you could have a situation where we might be at 4% or 4.1%, and the US at 3.25. So that creates an interest rate differential. What that means is the US rates will be lower than the Aussie. And if you look across in the tables, you'll also see the 10-year government bond yield in Australia is about 4.8%. In the US, it's closer to 4. So what's going to happen is there's going to be a rush, not a rush, but there'll be a steady flow of money into Australia to take advantage of higher interest rates. They call that the carry trade, and they'll often hedge their bets currency-wise, they make free money. If they're sourcing money in the US, investing in Australia, we'll see that rate differential. Now, what the overflow of this means is the Aussie dollar has risen. And to see the chart I've got at the bottom left of the page here, that shows in the last 12 months, the Aussie dollar going from low 60s, about 63 cents, into 70 cents. And that last little bit has been quick. And that's been as the markets have come to this realization that interest rate differential is just one of a couple of things. Generally, our currency will depend on interest rate differentials with other economies. So if we're looking at Aussie US, what's the interest rate differences and what's that trade balance? What's that terms of trade like? For Australia, we tend to be stronger Aussie against US when commodity prices are rising. You're also looking at long-term standard of living in those countries as well. It's really complex. No one can predict very well currencies, but we're seeing this rise here based on a few of those things. So if you're heading to the States in the near future, it's going to be cheaper than it was over the last year by a little bit. And we expect this might continue, although it's always hard to know what's baked into the price. So in other words, the market's responded now expecting this to happen. So even when it happens, it may not change things because the market knew. It's what happens next that's going to be more important. Extending down that news, not a lot of else has changed. CPI, and you'll see on the right there, Aussie CPI monthly at about 3.5%. The measure the RBA uses is at 3.6%. US inflation is about 2.4%. So they've got it back under the 3% for now. So that's giving them the leeway to drop rates. So we haven't been able to do that. And depending on who you want to read about or follow, they're blaming different things from everything from energy to the government. And there's a little bit of all of that as to blame. What that means is the banks have immediately responded with an increase in mortgage rates. So from 5.2 to 5.34 on the lowest that we see. Macquarie's variable also at 0.25. So you'll see an exact response of pushing it up to 0.25 that the cash rate went up. And term deposits. Macquarie's 1-year term deposit is up to about 4.7. So they're chasing that cash. Macquarie is the cheapest of the big four in the lending market at the moment. They're aggressively pricing themselves under. I'll show you those rates towards the end of this presentation. The care returns, when we're looking at over a year, it was a solid year by any means. Good results, both compared to our expectations, but also compared to others. The funds continue to be above average in performance, which is our target. And you can see almost clockwork, almost textbook, 10% for high growth, 9.3 for growth, 8.12 for balanced, and moderate about 6.4, conservative about 4.77. So once again, you look at that 10-year return and pretty bang on 10% over 10 years. It's kind of the assumption that I use in planning before allowing for fees. And it's important to note that we're getting those returns after fees. So that's allowing us to predict what your plans look like, what your performance looks like going forward. Not so much predict, but the planning is proving to be accurate based on our assumptions. Those assumptions down the side there, inflation plus 6 for high growth, 5 for growth, and inflation plus 4%. And we're getting those results, comfortably. I won't say easily because it's hard work. So all that's to the end of January. We have not changed our dial. So in terms of where we think the markets are, we think they're expensive. We debated whether to drop it to 9, but we weren't quite there. So because markets have gone sideways a bit over the last few months, and because earnings results in both Australia and the States are good, that's lowering the degree to which the markets are expensive. And if we were to go sideways a bit longer, we'll probably be dropping that to 9, but we'll see what happens. So it's just still, and the main use of that dial is for people entering the market with fresh money, just to go in a bit more cautiously. So our wall of worry model, alive and well, our last little downturn was the Trump tariff tantrums of just under a year ago, March, April last year. But you'll see the point of this is always that there's regular downturns, fear of this, fear of that, fear of this, fear of that, all the way through, which can cause drops of between 10 and 20% quite regularly. In fact, 7 of those since the GFC. The bigger ones are much rarer, but they do happen and normally through a boom. Here's that interest rate differential again, and you can see the pattern. In Australia, since October, we were down about 4.1, very close to the States. We've seen us rise up to about 4.8, while the States has kind of went up and it's come back down, kind of steady. So that's the main difference. You can see at the top, on the top left, that thick green line has dropped. So the US yield curve is moving down. It's at the lowest it's been over the last 6 months, but the Australian yield curve has moved up. It's at the highest been over the last 6 months, and that differential has widened. So that's what's causing the Aussie dollar, or partially causing the Aussie dollar to go up. Now, let me do my usual editorial. And this page, I pick out something in the marketplace that's going wrong to reinforce our broader philosophy, exciting life and borrowing money, not the other way around. Lots of people chase crypto to try and make a quick buck. Crypto's not what I would call an investment asset. As I've discussed with many of you, I would call it a trading asset. And that means, or trading, it's a speculative thing that you can trade. And for people that are good at it or get lucky at it, they can make a lot of money really quickly. You can see, you can also lose a lot of money really quickly. So crypto, or Bitcoin in this case, which is one of the coins, is down 46% from its peak in October. Now, these things are happening pretty regularly. To see the chart on the right, crypto's had 1 wave, 2 waves, 3 waves. And this was the 4th wave since crypto sort of kicked off. And that's, so these waves are happening every 3 to 4 years. Now, a share market or property investment cycle might be as long as 15 to 25 years. So it's very different. So this is quick. And personally, I'm happy to be out of this speculative market and be happily investing in the markets that we invest in. So you may have heard people talking about their losses in crypto, although they're usually much louder talking about their profits. I don't know what place crypto has in the world going forward, if it has any. It may have, but yet to see it. It's quite interesting that this latest downturn in Bitcoin has happened while gold's gone up, because they have been in sync for part of that increase, but they've broken that link. And it's very hard to know what happens with crypto going forward. I should point out the last major downturn, which was 2022, crypto went down 74%. So we can see that this downturn is still dropping. Whether that holds still where it is or whether it drops further, time will tell. But either way, glad that we are out of it and it's not a thing that affects our portfolios. Just keeping in the headwinds and tailwinds slide that I did before, and marking things that are changing or potentially changing from our thesis at the start of the year. So, one of the tailwinds I had down was easing monetary policy, lower interest rates. So I've highlighted that because even though interest rates are looking lower in most places around the world, they're actually just headed higher in Australia. So that's going to turn that tailwind into a headwind. I'll talk more about that when it comes to property shortly. And we've seen the valuations of a lot of the Mag 7 or the prices come off, including other areas of the tech market. So that decreases that headwind, because when prices come back, it makes them more reasonable and slows down any reasons for drops. I'm not going to go through the rest of this, but I'll keep this flowing as we look at what might or might not hit. I did see there's a private credit company in the States, which in the news this morning looks like it's kind of blowing up. It doesn't look like that's going to be systematic, but there are going to be more little pockets of private credit, and I'll probably do an expose of that next month in the Exciting Life Borrowing Money. But it is something that we worry about, and we're avoiding completely private credit, private equity at the moment, because reasons we've talked about, which is basically too much money's gone in, deal quality's gone down. And let's jump forward for that. So just reiterating our sort of model of the share market, which is it goes through these psychological cycles, boom and bust, and we then rate the market as to whether it's in the wall of worry, which was the normal period where it wobbles up the hill with all these little downturns of 5 to 20%. But eventually we stop worrying, not very often. Once every 20 to 30 years, we have a boom followed by a bust, and then a rebound, and off we go back into the wall of worry. That's a cycle that repeats. Always impossible to tell exactly how it's repeating, but you can it's a great way to assess kind of where we are. And as I said, we've got the dial at a 10, which is just expensive. Doesn't mean it's going to go down. Markets can stay expensive for a long time. Results can get better, which justifies the degree of expensiveness. We can see here that every downturn of more than the lowest one here is down about 25%. Every downturn of 25% or more has recovered over the next period, and they all happened, with the exception of COVID, after markets have boomed. So it's knowing where we are in this is really important. It helps us make good decisions. More importantly, it helps us not make bad decisions. In our most investment method up, I focus on that short-term focus, which can be extremely expensive in the long term. We see that in a number of ways. Whenever we're getting a market correction, the one that comes out the most at the moment is we're having more conversations with people, whether that's clients or people coming on board or friends and family about gold. Gold spiked up, so everyone's focusing on gold. Should we buy more gold? Now, the answer to that would be if you could go back 2 years, yeah, you could buy more gold, but now that's gone up a lot, maybe it doesn't go up so much going forward. In fact, in our investment committee meeting, I'll talk more about this when I get to the market analysis, but we've actually, we'll probably have gold as on watch. I'll explain what that means shortly. Behavioral instinct of the month is herd instinct, aptly displayed by gold in the last little while. You'll see queues outside all the bullion companies of people trying to get in and buy gold. Sometimes you see queues when they're selling, but at the moment they're all herding. This is about herd instinct, which is where people act together. It's even more common now in the world of social media, and where people can be focused and on certain. If you start reading more and more, or watching more videos about what's happening with gold, the algorithms of all the Facebook players will send you even more information. So it becomes overhyped in your mind because you're not getting a balance, because they're feeding you more of what you want to hear, and that increases this herd instinct where we all go up and then all go over the cliff together in panic buying and panic selling. Now, in terms of our core pillars, I focused once again on volatility is inevitable. We're going through some mildly volatile, I'll show you the charts in a minute, some mildly volatile times where the market's having a bit of a breather. That breather is really healthy. If the market goes up and just keeps going up all the time, the downs eventually are likely to be bigger. I never mind when the market takes a break. And it also gives our clients who are just putting large amounts of new money in the market a chance to bring forward or to buy cheaper as well. So let's have a look at what those charts look like. You'll see the Aussie market shown here. Off the back of that, a year ago, the Trump tariff tantrum and then recovery. And then we've just sort of been bouncing around. We're kind of not far off the same level of about September. So even though we've just hit a new high, it's only just a new high. And you'll see solid returns, not spectacular, 7.75% for the year. But the Aussie, remarkably consistent, 10% over the last 10 years. So bang on the long-term averages, pretty much. And BHP is back as the number one company in Australia. It's a battle these days between it and Commonwealth Bank, and they tend to swap, rotate, depending on the mining news or banking news. But they're both massive companies out there and much, much bigger. It's a pretty close race. You'll see the market value, and I've got to get my billions and trillions right here. But BHP, just heading out Commonwealth Bank. We go to US shares, and keep in mind this is US shares as from an Australian point of view, and that means when we have currencies rise, that affects our impact. So what I mean here is, if US shares drop and the Aussie dollar drops, you don't get a downturn as big in Aussie shares. So whenever we've had the big corrections, think GFC, international shares dropped 50%, but the Aussie dollar went from $1 to 50 cents. So that sort of hedges those losses. They don't drop as much. But the same is true on the upside. If international shares or US shares are going up and the Aussies also going up, it blunts the upside. So what we've seen in the last few months, and I talked about that currency, the currency's gone up, but international shares have dropped. So we've actually, that's actually done the reverse. It's exaggerated, and you can see we've got a negative return for US shares over the last 3 months, and you'll see over the year it's now down to 2.7%. Now, still extremely healthy over 3, 5 and beyond, and spectacular over 10 years. You can see the value of $10,000 invested in US shares for an Australian investor up to about 39,000, but down from about 42. So So, but once again, volatility is inevitable and unpredictable. You've seen the price earnings ratios drop back from these top big Magnificent Seven companies, and you can see the difference returns as we look there. Apple's up 8% for the year. Nvidia is still up 34, but it was up much higher. So that's relative. Microsoft has actually dropped. Amazon's dropped. Broadcom, so the chip makers are still up a little bit. Google is up quite substantially, as people think it's probably got a big part to play in the AI race, and it's increasingly looking better and better in that space. Now, trying to pick these winners and losers is always impossible, which is why we love index investing, where we can sit here and say, well, we've averaged out the losses and the winners. We haven't had to try and pick any of that, which is almost impossible. Well, it is impossible. So indexing is a great way to get exposure to everything, including the changes. Global leaders, much the same story, and they're much of the same company. So it's down over the month. 1 year, not quite so bad, and massively healthy in the long run. US small caps, it's been a tough year, down 3%. This was the one that 4 or 5 years ago was running hot, and it's eased off. But we're seeing that not as bad. Say it's positive for the month compared to the large caps being negative. You'll see a very, it's not doing much at the moment except going up and down a little bit. And as the benefits of the tech changes around AI, robotics, and all these things flow into mainstream companies, they're going to become more profitable, and these small caps are often the first to react. So comfortable with all these in the position. It's been a stellar year for emerging markets, and outside of gold, emerging markets have been the best performer in the funds and in the share market world. Not going down to individual countries where some of these emerging markets are up quite a lot. 26.99% for the month. For the year, 3.56 for the month. Now, it's only 3 to 5 years ago that these things were very flat. They've been battered around for a variety of reasons, but they're coming back with a vengeance, particularly over that last year. And that last year boosts all the other returns, and all of a sudden, 10-year return is back to 9%. We actually expect it to be closer to 10, 11, maybe 12 in the long run, just because emerging markets tend to outperform large cap, but it's certainly coming back and heading that way. Gold, 14% for the month, in spite of going up and then down. 64% for the year, and this is all to the end of January. So since then, it's actually bounced around, come back a little bit of profit come out of the system, but still extremely healthy. Now, in the active portfolio, for people that hold our active portfolio, we will take profits from time to time. That active portfolio has had a return of just over 22% last year, in part driven by gold. But in the last 10 years, we've had a return of between 12 and 13%. So about 3% above the broader share market, which it's been driven by about 5 decisions over that 10 years. So we're not very exciting here. We only take these profits when a market seems really high and then there's a turning point, and that triggers, and we've got 5 elements in our active portfolio, including gold. The other 4 elements we're always open to going and watch. But in Trump 1, we decided we were going to not be on watch for gold for the foreseeable future because of it acts as a hedge and it can jump and go down really quickly. So it's very hard to trade. We're just happy to have that as an insurance hedge. We've changed our policies slightly in that we now will go and watch, and we may have a profit target where we would, if gold dropped below a certain level, we would absolutely take a profit and then attempt to get back in. So that's been a change from us being never going to go and watch for gold to now open to being on watch. And I won't tell you the full story there. We've got our trade secrets, I guess, if you like, on how we do that. But it's a big change because it's gone up so much. And look at the bottom right-hand chart. You can just see that, $10,000 invested in gold, boring, did nothing for 3 years. And it slowly climbed up to about 20,000. Then it's gone from 20 to 50 almost in the last 18 months. So spectacular rise. That just means, we've got a stop loss set. We may take some profits out of that at some stage. Let's jump into property, and I saw a really good article from Metropole Property, a guy called Michael Yardney, and this was his kind of summary about why properties keep rising. It's a full article here. If you Google Michael Yardney Property, you'll find it. Anyone's interested, send us a message and I can send you the link. But the key takeaways I thought were important, because we have this contradiction. Property prices keep going up, but we hear about how hard it is to buy property and how unaffordable it is for many Australians. So let's have a look. So we know affordability is worsening, but property prices have actually been set by the buyers that remain active. So there's plenty of people with good income earners, business owners making money, investors, and downsizers. Now, these groups are less impacted by rising interest rates. In other words, interest rates as they rise, it doesn't impact them as much, and they continue to transact, particularly in desirable, tightly held suburbs. So think eastern suburbs in Sydney. Think a lot of the Sunshine Coast these days. That is a desirable place to live, but also any suburb that is desirable, particularly for the downsizers or the right sizes. And we're seeing the third bullet point there. There's a growing number of sales being made without any mortgage whatsoever. Over a quarter, so 26.5% of 2024 transactions in New South Wales, Victoria, and Queensland were all cash purchases. And that's because we've got these right sizes. That's people retiring or moving to retirement, selling expensive family homes that they may have sat on for years and years, and they're buying smaller properties outright, which is keeping price up. They don't really care whether they pay an extra $50,000 on it. They just want to be in the right spot. Now, that combined with them freeing up money means the bank of mum and dad is alive and well, and early inheritances. I know we're helping our kids get into property and happy to give them some money to get them in. Doesn't change the game completely, but it's pushed up prices. So that next bullet point describes this exactly. Wealth transfers are helping younger Australians overcome deposit hurdles and boosting demand in entry and mid-tier markets. At the bottom of the market, where first home buyers are active, we're seeing prices really strong, and government incentives just add even more competition. So there's a lot of criticism about the government when they give out a handout for first home buyers. All it does is go straight on the price. There's not enough property. One of our kids and their partners just recently was successful buying a property. They had to put in 20 offers on 20 different properties before they got one. And I was talking to some colleagues the other day and going, I've bought a lot of properties in my time. I don't ever remember not getting a property that I wanted, and maybe once. So all of a sudden these kids are showing up at auctions, failing, putting in offers, getting beaten over and over and over. So 20 times to get in. So quite phenomenal. And rather next in the market. So people like our kids, instead of exiting the market, they're just adapting. They're moving to different suburbs. They're chasing more affordable markets. They might be looking at units over houses, or they're rent vesting, where they buy a property to rent out and they'll keep living with mum and dad. So they're being adaptable. Quite proud of this generation, as everyone says, they're never going to own property prices. There's plenty of them that are getting active and buying properties. So continuing on the left-hand side there on the second bullet point. So that's all these things have broadened demand across different segments. But here's the big one. I'll talk about it again in a minute. But chronic housing undersupply is the biggest fault. There just are not enough properties. As long as that's the case, that keeps the supply-demand imbalance, which is pushing prices up. The only way to drop it is to make a lot more houses, and it's not going to happen quickly. It will happen, but it won't happen overnight, as they say in the classic. And then lastly, combined with cashed-up buyers and intergenerational wealth, this imbalance ensures prices keep rising even when affordability says they shouldn't. So don't expect that to change just because some people can't afford to buy in. There's enough people in the market with money to make this market pretty stable, and no signs of any correction in that anytime soon. Just in terms of, I've updated a couple of these headwinds and tailwinds too. We've interest rates, falling interest rates supported that upward cycle. We've now got interest rates turning, and if there's one or two more hikes, will that slow the market growth? That previous article says maybe, but probably not much, because bullet point, the last bullet point here, for the undersupply of properties is going to persist for some time. with pretty much all commentators agreeing there's no way we're going to hit the construction targets we need anytime in the next 2 to 3 years. And until governments can address that at all levels, because a lot of it's about development approvals, it's about freeing up land, it's about doing things that are unpopular, like making the ability to build units in suburbs that have traditionally been houses. So the not in my backyard syndrome is alive and well. As in, yeah, we need to do that, but just not in my suburb. And governments aren't very brave. So we're seeing a little bits of it, but not enough at this stage. But eventually the market does work it out. The developers will get more savvy, they'll push harder, we'll get there eventually, but who knows how long it's going to take. Let's have a look at some of the price action in the capital cities. So on the left here shows the fluctuation between solid growth coming out of COVID, coming back to earth a bit, but then shadowing so at the moment, that growth. And we've got Sydney, Melbourne, Brisbane, Adelaide on the left, and then Perth, Hobart, Darwin, ACT on the right. And you can see from Melbourne at 0.8% and Sydney as their growth rate right now. Now, there's a lot of disparity in the averages. I read an article this morning on a property in Sydney that sold for 500,000 more than when it was bought 3 years ago. So there's still plenty of gain where people are fighting over the right location. But on average, Sydney and Melbourne flat for the last 12 months, whereas on the right you can see Perth, Hobart, Perth in particular up quite solidly, as is Brisbane. And this is from probably OnTrack Index. So I always look for different data, but you can see the difference. So the big difference here, have a look at the 5-year growth column. And the lowest of the capital cities is Melbourne at 14%. The highest is Perth at 97%. Brisbane, Adelaide, Perth all in the 90s. And then you've got some low ones. Sydney in the middle, steady march as always, 34% along with Darwin. So that means, yeah, there's a lot of differences. So while Perth is nearly doubled over that period of time in 5 years, as has Adelaide and Brisbane, Melbourne's hardly moved forward at all. And yeah, I'll talk more about that, but it makes sense. Assuming things come back to the averages, you can see on, and this is all properties, houses and units. Now, Melbourne does have more units than other cities, so, but you can see Melbourne at 849,000. It sits number 2 on this list because that's where it's traditionally been, but at the moment it's headed by Perth, Adelaide, and Brisbane. That is not a normal thing. You'd expect that to come back over time, which probably means Melbourne will move back. There are some very local conditions in Victoria around land taxes and other issues, government debt, etc., that is putting a dampener on that. But when that breaks, that'll probably change. And you can see that, where we are at the moment, 17.5% increase in, and what we got, change in dwellings. We've got the annual change in house prices there, and that comeback. The Perth at the top there, 17.5%. I was just trying to work out my oranges and yellows there. 17.5% compared to Sydney at 6.4%. And yeah, the bottom of the ladder there, Melbourne. Same numbers, different ways to show it. And looking at the other side of housing, which is interest rates, for those not in that 26% that have cash purchases. And our old source, Mozo Home Loans, are no longer publishing their charts that we've shown here. So this is a table from one of my AI tools, checked to make sure it's accurate, because AI is not always accurate. But I just said, show me the top 4 banks, the headline rates at the moment. There's always deals to be had across the variable and fixed rates. And you can see 5.69 Macquarie up to 5.94 ANZ. And these go back and forth, but Macquarie is the most aggressive across all segments. Then you can see 1-year fixed rates at 6.19, so higher than the variable. 2-year fixed rates a bit lower at 6.09. The 3-year fixed at 5.99 is closest to the variable. And for those that were trying to budget and make sure that interest rate rises wouldn't hurt their budget, so if they were tight, we'd certainly be getting them to consider 3-year fixed rates at the moment, just to lock in their cash flow for 3 years without worrying about it happens. Now you can lose from that if rates drop, but there's 2 reasons to fix rates. One is if you're trying to predict the future. Good luck with that. We've already seen that. But the other is if you're just trying to be certain about your cash flow, and that's a good reason, regardless. So there's some rate happenings there. And as we look at our property clock before we finish up, This shows kind of, yeah, part of that Melbourne coming into that value area, along with regional Victoria, Geelong, Bendigo, Ballarat, where it's quite probable that given the right circumstances, they could be. Now, buy value doesn't mean they're going to go up straight away. It just means they're cheap. It takes the momentum, so something to then trigger that. But I was doing some research for myself on the weekend across vacancy rates and rental yields, and yeah, Melbourne units there that are yielding 6%, vacancy rates in some suburbs like Carlton down about 1.6%. So the metrics across Melbourne are starting to look okay. When that leads to an increase, who knows, but certainly much cheaper. Perth, yeah, from our friends at Performance Property, Perth still looking, like it's got some momentum, and you'll see Sunny Coast, Adelaide, Gold Coast more at the peak of the market. Sydney, Newcastle having sort of dropped a little bit, or got not dropped, but downside risk and potential to stagnate. This is just a model, so this can change really quickly, and supported by the other one that we use there as well, from Heron Todd White, the national values. So different models, both useful. Always somewhere at the bottom of the clock. It's always hard to predict, but probably is one place where with some really good analysis and help, you can buy smarter than other places. But once again, not perfectly predictable. So there's always a bit of luck or good judgment, whichever way you want to claim credit for when it goes up. So just summing up, as always, our core beliefs: investing is best done as part of the real plan. That's where you've got real goals that are based on what's important to you. Portfolio is designed to meet those goals, and we take a long-term view. Boring stuff: diversification, asset allocation, getting that right, and having enough liquidity to survive the downturns. Low-cost index funds for most growth markets, and protecting against short-term volatility with enough reserves for our retired clients, and averaging for our wealth accumulators and people entering the markets, and we rebalance it regularly. There's not an investment committee meeting where we don't have something to rebalance, and that's where we're just selling something that's gone up a little bit, buying something that's gone down a little bit, and that effectively funds fees, and is one of the secrets to getting above average return. As always, there's only 3 ways to lose money. I'm glad to say our clients just don't do it. One is panicking and sell when markets are down. The other is having to sell when markets are down. And the last is being not properly diversified. We have beautiful, boring diversification at work. So we've always got some winners, even though we have some losers, but the averages work through. Thank you as always for listening. And I look forward to continuing the conversation, whether it's here or when we next see you. Until next time, Rob McGregor signing out.